Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. So let's talk about the UK. So the UK recently increased interest rates, and they did that because they had a hotter than expected inflation report. The inflation report came around 10.4%, basically higher, way higher than what the analysts and the economists were expecting. We saw that the curve it was coming down from its peak, but it did spike up, which was quite alarming after all the tightening that the Bank of England has been doing, and actually all the tightening that all the central banks have been doing. And that's what caused the increase in the interest rate in the UK because of the scorching hot inflation. Now, I'll put the link in the description for you to read up on this. It's a little bit of an old article. This article comes before the rate hike, so don't mind that the article is a little old, but there's a section in this article that I want to bring up, which is really important. It says UK food and non-alcoholic drink prices soared 18%, the fastest pace in 45 years, and increases in clothing costs accelerated. Core prices, which exclude volatile food and energy, also picked up last month to 6.2% after decelerating to 5.8% in January. Services inflation also increased, jumped to 6.6% from 6%, a sign of increasing domestic wage pressures that is closely watched by the Bank of England. Now, we're heading into the summer months, right? You can expect more of also the services component to see an edge up higher in inflation as people go out and they travel and they're spending and whatnot, especially if people are still not feeling the pinch with all of these inflation issues. And I'm not saying that people are not, there definitely are, but this could be a sign saying that, hey, whatever the central banks are doing, whatever Bank of England is doing, it's still not enough, which is why you see the yields when this inflation report came out, especially the UK yields on the short end, went up, right? So eventually, to get inflation down, and according to Bostic, the Federal Reserve member in the US, suggested that you need to follow the Taylor rule, right? Taylor rule, in order to get inflation down, you need rates to go above the inflation level. So that means rates need to continue to go higher. Now, if the current rates that are being implemented are not doing anything, then that may suggest that the central banks may have to hike rates to really extreme levels that will eventually break the back of demand and eventually break the back of inflation to get it down lower. So either two scenarios could happen. One, we could see the path that central banks continue to hike rates, nothing breaks, right? Summer goes on and in fact, inflation still doesn't come down. It still edges up higher, or it's in line. It's still troublesome, which means the central banks need to do something to get inflation down lower. So that means hiking more. And we saw the catastrophe with the hedge funds, the pension funds, that almost imploded because of the hiking of the rates. So if the Bank of England goes back to hiking rates, and going back to hiking rates aggressively because inflation is not coming down, then that leads to the other road, which is that hard landing, which is that something needs to implode. Maybe it's the pension funds in the UK, maybe it's bank runs in the UK, maybe it's commercial real estate in the UK. Something in the UK needs to implode, and that would eventually cause a trickle effect, which would cause demand and eventually inflation and prices to come down if things get worse off. And how does that happen? Well, just take a look at just last year, when UK pension funds were about to implode, and then the Bank of England had to come back, step in, create some easing conditions, buy bonds to bring the yields down. But guess what? If you're buying bonds and bringing the yields down, that creates another reason for inflation to go higher if you're easing, especially. So now the Bank of England kind of put a lid on all these issues, the issues are still there, it can exacerbate and just basically explode if they continue to hike rates, which is likely to happen if these next coming months, and especially the summer months, nothing really breaks, inflation's still elevated, and the economy's still doing fine. Then that gives the central banks more reasons to continue to hike until something breaks, and then they can basically go back to easing. But it would mean that something needs to break in order to get the inflation down, in order for the central banks to win against inflation and then start cutting rates and start easing, which doesn't look good. So let me know what you guys think. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.